Hi, I'm Nic Spicer, and welcome to the Pmx Quarterly update. After a remarkably calm last 2 years, volatility picked up in the first quarter of 2018. Worries were initially centered on inflation, as wage growth data in the US came in stronger than expected at the end of January. While subsequent data cooled inflation fears, the market found something else to worry about when the US introduced tariffs on imported steel and aluminium, and later a 25% tariff on 60 billion of Chinese imports, which has prompted retaliation from China. Risk assets fell over the quarter, with a generally strengthening pound accentuating losses to UK investors in most overseas equities. Pacific ex-Japan, global property, and UK equities were the hardest hit asset classes, all down around 7% in sterling terms. After a difficult first 2 months, global government bonds posted strong returns in March to end up over the quarter, the best performing asset class, albeit up only 0.3%. Over the quarter, portfolios fell in absolute terms, although diversification limited falls when compared to UK or global equities. Relative performance was also solid, with portfolios generally in line to slightly positive relative to competitors. Asset allocation was broadly neutral over the quarter. An overweight to UK equities and global property detracted from performance, whilst overweights to Japanese equities and emerging market equities were supportive. Fund selection was also supportive over the quarter, with fund picks adding alpha in aggregate. Worries over a tit-for-tat escalation in trade tariffs derailing growth is fueling current market concerns. Coupled with this, US tech is under pressure after a strong run-up, as stocks are hit with idiosyncratic issues such as the privacy breach in the case of Facebook and Trump's Twitter attacks on Amazon. That said, global economic fundamentals remain strong. A trade war could certainly derail this, but the currently announced tariffs from the US and retaliatory Chinese tariffs are small relative to global trade overall. There is every incentive for the US and China to stop short of a full-on trade war. Serious market sell-offs generally go hand in hand with a recession, and although recessions are tough to see in advance, current economic data are still pretty unambiguously strong, which should mean we're not quite yet at the end of the cycle.